This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning a couple of noted market experts and well-recognized financial writers. No stranger to our regular listeners is Andros, the president of TraderView, publisher of the TEDBits website, and writer and editor of his very well-recognized and popular newsletter, TEDBits. Also joining us today is David Chapman from Toronto. Welcome, guys.
Welcome.
Thank you for having me.
David, maybe we could begin by you giving our listeners a perspective on your background and your writings, because they may not be familiar with yourself.
Okay, my background was economics from university, and I spent 25 years as an institutional money and foreign exchange dealer, trader, manager with financial institutions here in Canada. And back in the mid-'90s, after my third or fourth merger, bankruptcy, or whatever, I decided to shift off on my own, got my broker's license, and decided to just be an independent broker, viewing it as a way to build my retirement fund, and then quickly discovered that there was a huge gap in the industry, that the industry was largely a sell-side industry. So I decided to write from my 25 years of perspective of as an institutional money and foreign exchange dealer, which was a perspective that was not out there at all. And I've been writing ever since. It eventually led me to come into contact with a fellow by the name of Nick Barashev, who was somewhat like-minded, and Nick started up a company called Bullion Management Group, which is now a large bullion company. And I spent several years as a director of the company, and I've continued to just be an independent writer, trader, advisor.
To our listeners, I asked Dave to join us this morning because a lot of our listeners are interested in the precious metals market. And David is well-recognized writer on this topic. With the 7 sigma drop on I guess April the 12th, gold it just seemed appropriate to get some insider perspective on what is going on here. David brought some slides, and to start off with, of what's going on in the context of cycles, because I know you are recognized and you've done a lot of work on cycles. We just finished a series on the Kondratiev cycle, but not talking about gold specifically.
Well, the first place to start, and I'm going to try and keep everything as brief as I can, is that there are long-term cycles in commodities and gold. And one of the most interesting ones I read on long-term commodity cycles was some guys who wrote back in the 1940s called Dewey and Dakin, and they had identified effectively 54 years cycles of commodities. So it's split roughly between 27 years up and 27 years down. And applying that to the gold market, if one can recall, we spent from 1980 until the final low in 2001, a total of 21 years in a huge down cycle. And if you actually went back to the 1976 low, that period was about 26 years from low to low, which may have constituted a half cycle of the Dewey-Dakin model of 54 years. So I knew in 2001, if that cycle was correct, we were embarking on a potential long-term upcycle. In in not only in commodities but in gold as well. My background and interest in gold had always stemmed, and I was always fascinated by Nixon taking the world off the gold standard in 1971, and has a long-time money and institutional trader in money. I had to spend an awful lot of time trying to explain the mysteries and workings of the Federal Reserve and to upper senior management. And one of the things I couldn't help but notice was that after 1971, money, loans, and everything just took off into the stratospheres. And I eventually came to my own conclusion that it had to do with the fact there was no constraint on it anymore.
Isn't it amazing that no matter what chart you look at in a historical perspective, the inflection point is a tight band around August the 15th, 1971.
1971, exactly. That there was no constraint on it anymore. And the constraint and the removal of constraint was totally understandable, setting aside the fact that there probably was a default by the U.S. at the time. That central banks hated it because that meant that they couldn't expand the money supply the way they wanted to. And banks especially hated it because it constrained them in their growth ambitions. So the only way you could remove all of that and allow them to move forward and expand the way they want is get rid of the gold standard.
To interrupt there, I think we actually had a run on the gold bank on the Fort Knox at the time. France was demanding payment in gold. We'd already were shipping a fair bit offshore, or back, and Nixon basically had to stop the bleeding.
Well, exactly. There was effectively a raid because all that money from the World War II reconstruction, Vietnam War was sloshing around the world, and it was still convertible at $35. And the story went that somebody waltzed in with several $1 billion of U.S. dollars and said, "Give me the gold." And they, of course, I'm simplifying things here, and they, of course, they said, "Well, we hand you the gold, we won't have much gold left," and they closed the window. They defaulted.
The major point that was happening then was there was a shift to unsound money. Gold, going off the gold standard, clearly at the cusp of it. But just prior to that, the Vietnam War was going on. We had Johnson's Just Society was putting in, and it was the first time in history where we weren't financing a war. We weren't paying for it as tax was. We put it on our credit card, if you would.
Effectively, yes.
And ever since, we've never paid for it, everything we've been charging.
The U.S. not long afterwards moved from trade surpluses to trade deficits, and budget deficits became the norm.
Does this show up clearly in your cycles work on the site?
Well, it shows up in the massive expansion of money that was created following the lifting of the gold standard in 71, the freeing of currencies to trade freely in the markets. So money just exploded. And my interest was always twigged by it, but I never started really looking at it closely until after I stopped working with the big institutions and I started sitting at home and playing with charts and playing with numbers. But if we want to move along, the cycle, the gold cycle, assuming that the Dewey-Dakins model was correct, and there was basically 27 years up and 27 years down. There's always ranges in those. The cycles broke down. Cycles always break down into threes or twos. So the 25-year cycle or 27-year cycle would break down into three cycles of roughly 8.5 years each. And if one timed and if one went back to that 1976 low, there was very, very nice lows, never exactly 8.5 years. They never are exact, in around 1985, around 1993, and then 2001. So if that was correct, we knew the next 8.5 year cycle low would be sometime anywhere from starting maybe the earliest 2007, 2008 to 2009, 2010, somewhere in there. Sure enough, 2008, the big crash, that was probably an 8.5 year cycle low. So we knew out of that a new 8.5-year cycle was starting. And once we put in new highs above 1,000 at the time, it was confirmed. And sure enough, we went up to 1900. That meant that the next 8.5-year cycle low was due roughly in 2017, but could occur as early as 2015 or as late as 2018, 19, somewhere in there. Sorry, there are always quite a bit of period, but it's not unusual for these cycles to have a wide window as to when it can actually occur. The 8.5-year cycle breaks down into 3 cycles of roughly 34 to 36 months, or 2 cycles of about 4.5 years. The cycle from the 2008 low, sure enough, there was a roughly 34 months later, there was a cycle low in December 2011. And here's where probably I got fooled and all sorts of people got fooled. I figured that once we started out of it, we would start on a new 34-month upcycle. Well, that cycle topped out very, very quickly, and we have culminated in one that crashed into those lows in April of 2013. Now, that also coincided rather neatly with the window frame for a 4.5-year cycle low. I went back through charts. I've never seen both a 34-month and a 4.5-year cycle occur simultaneously. But obviously it can happen. But remember, gold has only had free trading since the 1970s. So there's not a lot of history to go on.
Do the silver cycle charts map?
The silver charts largely, when I say largely, overlay, according to the fellow I learned about the, not the Dewey-Dakin models, but the 8.5-year cycles and the 34-month, etc., was a fellow by the name of Ray Merriman, who's a financial astrologer out of Michigan. And I took all the things I read on his and went and played with numbers to galore myself to see if it was actually right. And to the best of my knowledge, it worked out very, very nicely. And I tried to always approach it from as I said, for a general audience rather than a very technical audience, which Merriman caters to.
Bringing that, Dave, to today, what's it telling you now?
It's telling me that this current crash, and one of the charts that I put out recently showed that the gold fell sharply down into the 4-year moving average. It can test those in a bull market. It fell down into uptrend lines from earlier lows, and it suggested to me that actually might be the low, but it's obviously at this stage of the game not confirmed. You can only confirm that low is in once it takes out points higher up. And obviously you can only confirm that a new cycle up has been started once it takes out 1900. And that's obviously quite a ways away. And that raised the possibility that in this current 8.5-year cycle, we actually topped at that 1900. That doesn't mean the gold bull is over by any stretch of the imagination, but that we may go through another up period here, another down, and the final low for the current 8.5-year cycle might come in around 2015, maybe 16, and then we have a big move to the upside. But in the interim, gains could be constrained, and well, maybe constrained is not the right word. We just won't take out 1900.
We do a lot of work here in it with the triggers, and in the work that we do, we rely very heavily on Fibonacci's and concentric ellipses and various techniques from that. And our work is telling us that the right now, it could extend out into 2014 before we actually get a hard bottom that may not be significantly lower than it are, but really it's about time right now. And I say that in the context of technical damage that's been done. If we were only to look at it from a technical perspective, the bigger driver here is really the macro, because the conditions can change and will change that can change these charts fairly dramatically. You started to decide whether the technicals are mirror that or whether there's a disconnect right now.
Well, there has been a disconnect, especially since that mid-April date.
The April 15th sell-off or the April 12th, how much of that is your feelings was, and I'm sure our listeners would like to know, was orchestrated, planned, and...
It was shocking because when you learned that someone came in with 400 tons of paper gold, some said 600 tons of paper gold, and offered it all at once, you realize that these people couldn't possibly be being able to deliver this, and that somehow along the line before maturity date, I'm assuming they were June futures, they're going to have to cover these futures and or roll them over into the next period. We have noticed a rise in the short positions on the commitment of traders reports, but it's a little bogus because longs always have to equal shorts, if you know what I mean. So while the total amount of shorts did rise, the total amount of longs also went up. And certainly over the past several weeks, there's been a steady improvement in what we call the commercials commitment of traders report, and a steady deterioration or decline in the commitment of traders report for large speculators. Of course, a major component of large speculators are hedge funds. So it was obviously from that group that the big short sale came. But then you start saying, well, who could offer that kind of size out there? And nobody's been able to answer this. There are theories. The most predominant one I've read is from this fellow by the name of Paul Craig Roberts, whom you maybe have read yourself, that was actually the Federal Reserve.
I hope to interject here soon. So
go right ahead. Go right ahead.
Well, Dave, we're here to have a little debate and, bring some intellectual stuff here. And I love what you're saying, but I'm going to give you my counterpoints to some of yours. And I am a black helicopter guy. I'm unabashedly believe that there's a lot of corruption at work in the markets. And that, basically the amount of money that's been printed and created makes any market in the world ripe for manipulation by the powers that be. And the powers
no disagreement,
that be,
by the way.
Okay.
No disagreement.
I mean, you understand that $20 billion worth of gold on April 13th is a rounding error on J.P. Morgan's balance sheet. And I believe that a run on the bank began, and I mean on physical metals, in the middle of January. And the run on the bank was at the primary holders of gold and silver, HSBC, the COMEX, J.P. Morgan Chase's depository, and the LBMA. And at that point, they were sitting there saying, well, we've sold a lot of metal that we can't deliver. And they can read charts as well as we can. And that they're actually masters at reading charts and painting the tape. And that that we got to that, I'll call it point where the market should have turned. The people were buying the pullback. They gapped it over a very short period of time, and then let their little mighty mites called high frequency trades go at it and eat the bid. Okay. And that they were doing it in such size that literally it told you that they were operating outside the law. And so they had to be doing it with the knowledge of the regulators and the Federal Reserve. And that they took it down, and finally buyers came in. And that we had a huge volume spike, which I'll call a capitulation in gold. And to me, gold was just finishing out time and price correction, because we've been in a 10-year bull market, and obviously we had a big correction in 2008, and I don't recall your 3.5-year cycle. So, to me, what's gone on is that they spanked the paper markets. They expected people to disgorge. In order to pay off those shorts, as you mentioned, they've got to deliver. And I believe that the people that are on the other side of this trade are people that want delivery. They're not buying gold for a trade. They're buying gold to get repatriation and final settlement on a worthless piece of paper called a U.S. dollar. And
now, are you referring to the shorts or referring to the people who would have bought all that?
People that bought it. I believe that China and India and other people are throwing paper back at us as fast as they'll throw real money back at them. And, to me, gold and silver is not a barbarous relic, but has been, money for 3,000 years.
Exactly.
Where the U.S. dollar has been, really people don't know that the U.S. dollar has actually died a couple times since the founding of the Republic.
Mm-hmm.
Like in the 1860s and 1790s, 1830s.
With problems, yes.
Okay.
Most definitely.
And, this is to me a fight between man and nature. And that Mother Nature really, in the long term, never loses these battles. She may lose a skirmish, like we saw in April, but that we're really looking intermediate term. Gord has posited that they're going to slap it one more time in other conversations with me, and they may, but they've got to let the price go to some place where people will dishoard gold that can be delivered. And if people won't dishoard gold at these prices or on this next slap, they've got to turn around and let the price go up to the point where they can have enough gold come out of the woodwork for them to deliver on the positions they've taken. And I believe that's directly in front of us, whether it's 90 days or 9 months. It is in a fairly short time horizon.
Our charts are suggesting it's within 90 days' time. And whether they're successful at this final slap, it'll be interesting to see whether, in fact, the bottom is in. But they need to do this, and the charts are also telling us, because in August and September, there's clearly a cusp of increased money printing coming, and whether it's overt monetary financing, which is just outright monetization. So the rest of what I refer to as the currency cartel follows Japanese level. When that starts to enter the market, even as rumors, and therefore this whole discussion on tapers starts to die off, and it will, because it's nothing more than a planned scare into the market. And if they put enough fear gold in here that when that happens, and when I say overt monetary financing happens, then in fact the run-up in gold will be significant, and they want to try and dampen that. And, as we've talked about previously, gold is running at around $215 per ounce per $1 trillion. And these balance sheets of the major G7s, or the major 7 currencies, we should see somewhere between $8 and $12 trillion over the next 14 months.
This is how this all fit into the cycles. This 4.25-year cycle low was due within 9 months of January 2013. So we are in the time frame.
Okay.
For this cycle low to occur. The target price zone was anywhere from 867 to 1365. We hit down to the upper end of that very, very wide band. So we have. So it is very possible that we are in the throes of the 4.5-year cycle low for gold, and that we are within the time, not only the time band, but we are also within the price band. But we can't confirm it until some event happens to take us up again. I always thought to confirm that low, we got to get back up into the 1600s.
Dave, what is your supply demand kinds of numbers showing you? I know you have a chart on that.
Everybody's been focusing on the big drop in the COMEX supply, and especially at the JP Morgan depository. But somebody asked me an interesting question quite a few weeks ago of how does that relate to the outstandings on the futures. And sure enough, guess who prints that chart? Nick Laird. So I went and took a look at it all, and in some respects, it actually didn't seem to be too bad, although the ratio had been rising steadily over the past few weeks. But I hadn't looked at it here in the past week or so. But it was not at a level yet that one would panic and say, "Oh my God, there's too much open interest to be able to for all that gold that's there. There's not enough gold there in the COMEX." So we haven't hit a really bad point yet, but it could. Yes.
Eric Sprott is out with some pretty good, as usual, very, very good work. And, he's looking at gold production being, had been fairly flat at around 3,700 tons a year. But we've had a delta increase in new entry into gold from either the central banks, exchange traded funds such as GLD, a list of items that he's put out that suggest there's, a delta of 2,500 tons. So he says that the clock is ticking here, where the supply demand is completely now out of balance.
Well, it has been for years. It's just that it had always been nicely made up by central banks and scrap.
And you're referring to the central banks actually leasing their gold.
Yeah. But that game is obviously over because the central banks are now net buyers. So you got to generate an awful lot of scrap. Does that make sense? I can't answer that question, but I've always said, wow, can they get that much from scrap? Maybe they can. I don't know.
Well, I don't know if you watch, but like in Portugal and Spain and Italy, there has been a huge dishoarding of gold just because they're in a depression. And yes. At the same time, we've got record gold imports into India, China, Hong Kong, throughout Asia. In fact, I would argue that they've taken delivery of more physical gold in the last 3 months than was sold in the paper market. And so we've got a lot of cross currents. I really, everyone would like to believe that the gold market's just set in New York and London, but I would beg to differ that it really actually is set by the fundamentals.
It's shifting to the east, and someone wrote that I read, we are making a massive wealth transfer to the east, meaning the West is making a massive wealth transfer to the east.
I'm finding myself watching the Shanghai and also the transfers in Hong Kong more to understand what's really going on in gold. And when you look at China right now, theoretically the official holdings are just over 1,000 tons. My numbers suggest they're going to buy somewhere between 1,500 and 1,800 tons alone this year. And they're already running at an official rate of 1,500 tons for the year. So those numbers I said earlier from Eric Sprott suggest that they're very, very conservative. And Ty, you just mentioned India, and I noticed, and I appreciate your comments on that. The Indian government just stepped in here in the last few days and have tried to ban buying of, or at least advise the banks to cease trying to sell or selling gold to private individuals.
Well, of course, that's going to start a stampede. I mean, it's, come on. Those people have spent generations being victimized by the printing press. They know very clearly that what's being printed is not money. And they're a very big savings society. They know that government isn't going to be there when they need to be. And it's just like the Chinese. I mean, they don't have social safety nets in India and China. The only social safety net you have in those countries are your families and your savings.
I had picked up a story here, too, that France has been trying to limit gold and precious metals being shipped via mail, which I didn't quite understand all the story, but it just seemed to be another attempt to control
they
it.
basically banned it. They basically banned the buying and selling of gold and silver in France. Okay.
Well, I don't know how you can ban it. I mean,
they just restrict. When you restrict the purchases to $200 or $300, you can really can't buy anything. Okay, I mean, $300 is what not even a quarter of an ounce of gold.
I think these are the symptoms. What we're going to see accelerating from governments is they, in futile manner, try and regulate, legislate, or control the physical at the public level, and probably to some degree the commercial. Ty, what are your charts telling you with the outlook of gold?
Oh, I believe that we're right near the end of the drawdown. That we've got some pretty good Fibonacci drawdowns coming off those 2008 lows, 38%, and that in time and price we're very close to either the final low or should see it in the next 90 days. You do much more sophisticated technical work than I do, Gord. But to me, the fundamentals, I am completely on your same page in that they're not printing fast enough.
Yes.
That the rate of growth in the central bank balance sheets is now, I just saw something from Jeff Grunlock that shows that it's basically at the lows for over 5 years.
Yes, and it got accelerated fast, and the ECB has got to move quickly.
And, of course, they're saying they're not going to do it.
That is garbage.
Well, it's garbage unless they want to have a barter system in Europe. Because the banks there are completely gone, as you well know, Gord, running at 50 to 1 leverage and 4 times the size of the GDP. So,
So that's exactly why I feel they have to do it. And just for our listeners, how they'll do it, in my opinion, in Europe is small business loans in mass. SMBs are going to be pulled onto the ECB books. That's a fancy, convoluted way of putting in quantitative easing and appeasing the Germans.
Well, they have to just keep the businesses alive. I mean,
well, that's another part of it too.
They've got 30 to 50% unemployment, and they're going to, extinguish 30% of the small businesses because, like in Italy, 30% of the small businesses are probably 90 days away from failure.
Yeah, we're starting to see social unrest accelerated in the youth. We're seeing small businesses fail, and the recession's only getting worse.
The social unrest, if anybody has looked at the Kondratiev cycles, the winter of the Kondratiev cycle, one of the key points is massive social unrest, which of course is what we saw in the 1930s, and the rise of extremist political groups. And you're seeing that throughout Europe. You're seeing it in the United States. You're largely seeing it throughout the Western economies, including even in Japan. So,
and the sad part, Dave, is we are seeing it, and hidden behind it is, for example, we have 47 million people here in the United States on food stamps alone. And if we were to go back to the Great Depression and put 47 million people in the food kitchens, we get a perspective. But all the countries have been able to paper it over. And despite that, we're now seeing it.
It's nice how they hide it by sending you your soup kitchen ration in the mail rather than make you go to someplace and get,
Well, exactly. I was just going to say that 47 million people on food stamps is just today's equivalent of soup lines.
If you want to see how those soup lines work, be at a Walmart at midnight as the clock ticks the new month, and you'll see hundreds of people lined up because it's at that time that the government recharges their card, if you would, and so they can buy. And it's just everybody's living from when the next tick comes out on their ration cards.
So I'm assuming that they're in there buying food, not televisions.
And not only are they just buying food, they've reached the point, Dave, where it's bare necessities. If milk and bread and the kids are at the point where, just making it to that next milestone. People at Walmart have pointed out continuously, and they're actually having to change their staffing, their hours, and their patterns to accommodate this new reality.
Yeah, and I'd like to kick in on the Kondratiev wave. Both Gordon and I do salute to that because this is a boom brought about by credit expansion. And I'm going to just say unequivocally that the deleveraging has not even really begun. In fact, global credit is still growing.
Well,
And that Kondratiev wave, that is the death of leverage. And we're going to see it. And these type of currency systems die in waves of insolvency. And of course, that's what a Kondratiev winter is.
Yep.
Waves of insolvency hitting and deleveraging and defaulting.
And the banks are in big trouble globally. Global banks.
Gordon and I would say to you that they're all operating in regulatory insolvency.
Although our Canadian banks are probably still not too bad because fortunately someone up here has the wherewithal and mind to not allow the Canadian banks to get quite as leveraged as the everybody else did.
At least the Canadian banks maintain some semblance of lending standards and making sure that people put the right deposits up and, they didn't destroy, the fabric of if you're qualified to borrow or also made sure that they put down proper deposits.
Rather ironic, because I'll tell you, because being Canadian, I know some of the story behind all that. It was the former Liberal governments under a finance minister who briefly became prime minister by the name of Paul Martin, who refused to let the financial institutions up here merge together, refused to allow them to loosen their standards for lending, leverage, and mortgages and everything else like that, even though they were pounding on the table demanding it. And then, oddly enough, when the tide turned and the Liberals lost and in came the Conservatives under current Stephen Harper, his hands were tied for quite a few years of his early reign because he only had a minority government, even though it was well understood that Mr. Harper was more than willing to take what was deemed as handcuffs on the financial institutions off to allow them to operate like the American banks. And of course, by the time that he was in a position that he could allow it with a majority government, along came the 2008 financial crash, and they really haven't done too much about it since. So it's rather ironic. If we'd had Mr. Harper in charge back in the 90s, Canadian banks would have been in the same mess as everybody else.
Your day still may be coming, Dave, and I say that because Canada has been up until recently still in a housing bubble, has not experienced a significant housing correction.
But our mortgage rules are sufficiently tight enough that people actually have to get a real down payment, and it's a lot tougher to get a mortgage up here than it is, or than it was, I guess, down in the States. I don't know what it's like.
And the mortgages aren't tax deductible in Canada as they are in the United States.
Tax deductible. I never heard of them handing out 125% or mortgages up here of the value of your home. I never heard any of that stuff up here. I remember when we had to buy a house, we had to find the down payment, and that down payment was 25%. Of the value of the house, and they wouldn't give you a loan for any more than 75%.
One of the things in the Kondratiev cycle is it's never went through an era based on the world being in a fiat currency-based system. Countries are, in fact, dominant across the globe. And we've also, what really stands out is typically debt is written off, bankruptcies, etc., and debt has been continuing to grow as we're in the end of that consolidation of Kondratiev cycle, which is suggesting that when the correction comes, or the deleveraging, because I totally would tie it, the deleveraging has not really started yet. But when it comes, it'll come in waves, and it will be fairly dramatic.
Obviously, the biggest growth in debt since the 2008 financial crash has been in government debt, largely because they bailed out the financial institutions, which they probably should have let go at the time. Rather than, when Goldman Sachs rules the world, you're not going to allow Goldman Sachs. So Lehman was the sacrificial lamb, it seems, at the time, but they basically had to bail out the system. Of course, as you well know, legislation has been going around to change all that so that no longer will it be the taxpayer on the hook. It will be the depositors that are on the hook if the banks go under. So that would be a massive wealth confiscation or wealth collapse, and part of the deleveraging process, because you can't have the debt collapse without having the assets collapse as well, as we well know.
Dave, Ty, we have to wrap now. Ty, do you have any final comments or questions for Dave?
Well, Dave, we'd like to hear just basically what you see in the cycles. And my bottom line is this, and of course, I believe paper always goes to its intrinsic value, zero. So the reciprocal of that in gold is quite high. And are we going to get there sooner or later? Sure, I have no doubt about it. I can't think of a time in history that we didn't. In fact, there never has been a time where paper didn't go to its intrinsic value. And so anyway, intermediate to long term, nothing's changed. We're actually having a breeze of deflation. And that breeze will be certainly addressed because central bankers, and politicians, and especially financiers who are sitting on too much leverage, when they have a gun put to their head, you can expect them to duck. And they're very good at ducking and letting the public take the bullet. And they won't deviate from that at all right now. And there may be slight spells where they think they can withdraw, but they'll be quickly, I call it boxed up around the ears. And so I'm a mega bull. I believe gold's going to 10 or 20,000, and that there'll be panic buying. I haven't really seen the public participate, and the public will be participating in a frenzy when we hit the highs. And I just am a mega bull. Like I said, I'm a black helicopter guy. I fully subscribe to the evil of government, and the money that's at stake and the power that's at stake will force them to do whatever they have to try to preserve their franchises. But I'm a mega bull on gold.
Dave, any closing comments?
Well, I remain a mega bull on gold as well. I, too, believe that the cycle will not end until such time as we're seeing a panic buying, as you point out, Ty. When that happens, whether it happens in this current 8.5-year cycle, which I'm beginning to doubt, it might not happen until the third 8.5-year cycle of this 25-year upwave. So it won't happen until past 2015, 2016, somewhere in there. If it starts to happen sooner, I'll be pleased, but the drop here this time caught me by surprise, because I'd never seen both a 3-year low and a 4.5-year low simultaneously. We're right in the period for that 4.5-year low. We should be soon starting to come out of it. How much it musters is difficult to say. One last passing comment, which I always find my really scary one, is that the Kondratiev winters have a history of global wars and strife. Certainly, the last Kondratiev winter culminated in World War II, and at the heart of wars, global wars especially, are currency wars. And right now, the guy fighting to survive is the U.S. dollar, because it's the world's reserve currency, and losing its status as the world's reserve currency would be devastating, of course, to the United States. So the powers that be, whether that be government, corporations, whatever be, are going to do whatever they have to do in order to ensure that they stay numero uno. Of course, the major challenger is China and the yuan. So it's for the United States, its challenge is how do you take out China without starting a global war? And I always think back when in the history that I read, not the history that's taught in your schools or that most people would probably accept, but World War I was really a culmination of a currency war. And the challenger, the numero uno currency at the time was the British pound, and it was under attack from the economic power and growing economic power of Germany and the Deutschmark. And they had been in a dance for years prior to World War I, which the Britain felt that they somehow had to take them out in order to survive the British pound. Of course, it wound up devastating both of them in a way at the end of the day. So you never get quite what you wish for. And I certainly hope that the current currency war between the U.S. and dollar and the yuan, China, doesn't end in some sort of a global war. I pray not, because today they have the worst weapons we can imagine, don't they?
Well, I actually guarantee it, and I agree with you, Dave. Just understand that, how many marriages break up on the subject of money. Well, just think what the rest of the world's going to do when they find out that they can't redeem their dollars.
Well, exactly.
Guys, we are going to break now. Dave, could you tell our listeners how they could learn more about your reading, your writings, and where they would go to find them?
Well, I do have a website at www.davidchapman.com. My website does need some updating. There is a small subscription thing just so you could talk to me, and it doesn't take up my time, and I make a couple of dollars. Although I've always thought of making it free again. But anyway, I do have that website. I am a registered broker up here in Canada, but I've always considered myself an independent broker, which is why I work out of my house. It's just a place to hang a license, the company that I happen to be with. And I write under their auspices, and I'm still connected with Bullion Management Group, and Gord, as you noted, there was a lot of my articles were sitting at Bullion Management Group, which is www.bmgbullion.com. Bullion Management Group is a company that you can buy mutual funds, Canadian mutual funds, for bullion and gold, silver, platinum, and just gold alone, as well as they have bars, and they store it, and it's all on an fully allocated basis. And they been a sharp growing company, but this last several months have seen them kind of had the brakes slammed on them too. But we all think that it's going, gold is going to go a lot higher, and that it is the thing that one needs to protect themselves money-wise going forward into the future.
Doesn't Nick Barishoff have a book out called Gold 10,000? So I assume you recommend it?
Yeah. Oh, yeah. It's very, very well written, and Nick has covered a lot of the major salient points as to why he thinks it, and it's all tied to ultimately to debt at the end of the day, which was one thing that got me into this years ago myself when I sat there and scratched my head and watched all this debt grow and grow and grow and grow, and said, well, there's no constraint on it. And knowing charts, I said, well, anything that goes straight up eventually collapses.
Dave, I just think you summarize how most of our listeners feel. They're scratching their head and wondering in amazement. We got a break now. Thank you both for the time this morning. Great conversation. Obviously, we're just touching the edge of many, many things we need to talk about on this subject, but I hope our listeners enjoyed it, listening to two people who truly know what they're talking about. Thanks again, and see you again, guys.
Thank you.
Thanks, Cord. And Ty, thank you as well.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.